The Federal Reserve is expected to raise interest rates again tomorrow after pausing more than a year of rate hikes last month. Experts believe the central bank will increase rates by 1/4 percentage point as part of its ongoing fight against high inflation. Meantime, the Bureau of Labor Statistics reported this month that consumer prices dropped to 3% in June. But that's still 1% above the Federal Reserve's target rate. If you're having a hard time following all of those percentages, joining us now is Joe Rennison. He is a markets reporter for the New York Times. Joe, thanks for joining us. The Federal Reserve has raised interest rates 11 times since 2022. What impact has this had on the U.S. economy and investors?
Yeah, a decent amount of impact has been had. Inflation has started to fall. That's the biggest one, and that's the main reason that the Federal Reserve has been raising interest rates, is to try and cool the economy, and in so doing so, reduce inflation, which I think everyone has been feeling quite markedly. But then it also has spillover effects to the rest of the economy. It has started to play an effect on the labour market and to affect the pace of hiring among companies, and it started to affect sort of business decisions, what companies are doing, investment, how they're treating their stock, things like that. So it filters out and it trickles out, and that's the intention of it. Obviously, the concern is whether that goes a little bit too far and slows the economy too far and pushes us into something a little bit less favourable.
Most experts anticipate the central bank will increase rates again tomorrow. What are the main factors officials will consider in mulling over this decision?
So it's pretty much nailed on, to be honest, at this point. The Fed doesn't like to surprise markets. It doesn't like to surprise investors. And the expectation is overwhelmingly that they will be raising by another 1/4 percentage point tomorrow. The things they consider and the things that they're making very clear that they're considering at the moment are incoming data about the economy. So kind of reflecting the way that interest rates move through the economy. They're looking at the labour market, they're looking at manufacturing data, they're looking across sort of consumer spending, how consumers are reacting, how businesses are reacting. And that's kind of what they're looking to make sure that the interest rates that they're enacting are having the desired effect.
So no surprises there, but obviously this would be the highest funds rate that we've seen since 2001. The question that I know we've talked about for months now, that R word, could this lead to a recession?
So it certainly could. I mean, a number of people on Wall Street have actually been dialing down that expectation. That was certainly the consensus view at the start of the year. The stock market is up roughly 20% this year. The economy has proved far more resilient than anyone on Wall Street really anticipated.
What do you attribute that to?
I am certainly not sure. Analysts and folks on Wall Street would probably attribute it to the strength of the consumer. During the pandemic, there was obviously a large amount of stimulus that kind of built up this kind of buffer of cash in consumers' bank accounts. They had a little bit more savings, had a little bit more in the bank, especially with the stock market, which performed very well through the pandemic. That also enriches people and gives them additional money to then spend into the economy. And so the strength of the consumer has really dumbfounded a number of economists, a number of analysts. They've continued spending. That has allowed companies to continue raising prices to deal with inflation. So their earnings, their profitability has not really slid in any way that sort of initial expectations kind of would have told us. And as a result, as inflation now is starting to fall, and the Fed is kind of approaching its target of 2% inflation, it's not there yet, the sort of optimism about the economy is rising.
Does it make it more interesting in covering these markets?
Well, the curious thing is this is also typically what happens before a recession, is optimism gets very, very high. So there is this other side of caution, right, that whilst people are feeling a little bit better about things, whilst people are feeling like we might be able to escape a sort of severe downturn, that's often when people maybe get a little bit over their skis, maybe start to, dial in that sort of hope a little bit too early, maybe. And there are risks out there. There's an awful lot of debt that was taken on whilst interest rates were very low. There are a number of companies that are facing much higher interest costs now as a result of interest rates going so much higher. So there are risks still to that rosier outcome maybe not coming to fruition.
All right, Joe Rennison, thank you for breaking all of that down.
Thank you.
Take care.